We have a voicemail number, 219-2-DAVID-P. This voicemail asks about something we have not discussed on the show before, but it's really important. Take a listen to this.
Hi, I'm Christine. I'm from Los Angeles. I was watching the Morning Joe program, and they mentioned that shadow banking is largely unregulated. What the heck is shadow banking? Can you explain it? Thank you.
Yeah, so shadow banking, as the name suggests, is banking that happens in the shadows, and specifically it means out of the view of regulators. Like, it's sort of in the shadows from average people, but it's also, more importantly, out of the view of regulators. And this can happen in two different ways. One is non-bank financial intermediaries that don't accept normal banking deposits are often unregulated. So this can include hedge funds, it can include certain types of derivatives, and many other examples. The other sort of meaning or version of shadow banking is major financial institutions that are normally regulated, whose banking activities are regulated, but who are working in a specific type of product that is less regulated. So you might have like a hedge fund that's part of or associated with a regulated major financial banking institution, but not every single one of their activities would be equally regulated. And if it sounds sketchy, it is a major factor, or it was a major factor in the 2007-2008 financial crisis. And a key sort of common factor in a lot of these shadow banking instruments is massive, massive leverage. Leverage, of course, being that you use a little bit of money to get a whole bunch more money on credit, which you then invest. And of course, the risk with that is that you can end up losing more than the amount of money you have. Like a simple example would be if you invest in stocks on margin, right? If you invest $1,000 in stocks, cash, that $1,000 could become much, much more, or it could go to zero. And the worst that would happen is you lose the $1,000. If you invest on margin, you might use those $1,000 to secure $10,000 in credit. You now have $10,000 invested, but you really only have $1,000 in actual cash. If the $10,000 investment goes to zero, even though you only started with 1,000 actual dollars, you owe someone $9,000. You are out $9,000. And that is why leveraged financial instruments can very quickly become extraordinarily risky. So yeah, the more money that's tied up in shadow banking, the more credit that is built up in shadow banking entities, the more risk that exists in the financial system. So good question. Haven't talked about it. Glad for the opportunity. On the bonus show today, we have had a shark attack in Cape Cod, very close to Boston, where a man died. I am going to talk about it, and more interestingly, I want to talk about shark attacks as a cultural phenomenon, which is very interesting. Doesn't make this death any less tragic. We will talk about scam phone calls on mobile phones, another topic of interest to me, and we will also talk about the growing list of questions about Amazon CEO Jeff Bezos's $2 billion philanthropic fund. Thank you for joining me today. One more program from Paris tomorrow, and then I will be back at David Pakman Show Studios at the end of the week.